Well, guys, Netflix just reported they missed on both revenue and profit. The stock is down over 7% after hours. Now, guys, I want everybody to remember here, if you're new to the channel, we like looking at earnings releases for the fun of it, but we don't believe in making investing decisions based on short-term fluctuations in the market. Quarter to quarter, companies are going to beat, they're going to miss. When I hear people see that the company missed, they think that means declining. No, it does not. It means their guidance was missed. Right now, they're down 6.8%. Let us see what they were expected to do. This is right off our website. Go to earningshub.com. They're expected to do $11.51 billion. They basically got in line there. I would say that. Earnings per share, they missed by 15%. They're expected to get $6.94. They made $5.87, and the company is getting butchered because of it. They're down 6%. Now, in this video time that we're going to observe this number, we have seen companies go from down 7% to up 5% in the 10 or 12 minutes it takes us to make these videos. All the more proof that these things don't matter. Are they fun to follow? Absolutely. Do we think you could do it to just have some fun? Absolutely. Use this when people are overreacting as an opportunity for you to buy great companies at great prices. The question is this a great price? $1,160 sounds like a lot, but remember, don't fall for that trap. Just because the number of shares is lower, making this price higher doesn't mean it's not a good investment. Let's go break down this company's release because they came out with their earnings release. Revenue grew 17%. Guys, 17% is a lot for a company this big. Now, a quarter of that was probably me because I buy these houses for Airbnb and every single house gets its own Netflix account. So I think that a quarter of this revenue growth was just from me. Operating margin was 28%, which was below their guidance of 31.5% due to an expense related to an ongoing dispute with Brazilian tax authorities that was not in our forecast. So operating margin is their operating income divided by their revenue, how much they make from the business. And they're saying, hey, we thought it was going to be 31.5%, but this dispute is going on longer and taking more time, so it's actually 28%. We don't expect this matter to have a material impact on future results. Okay, great. Engagement remains healthy. We hit our highest quarterly view share ever in the US, which has grown 15 and 22% in the US and UK since 2022. Wow. That's big. Guys, people watch Netflix and they love Netflix. What show am I watching on Netflix right now? I think my wife and I just watch shows at night, basically. I don't think we've watched a specific show made by Netflix in a minute, but I don't know why that is. We haven't watched much TV as of late, which is very unlike us. We like to watch TV as our couples thing. All right, in quarter three, we made further progress against our 2025 priorities, delivered a great slate, great, awesome, happy. I haven't seen Happy Gilmore 2 yet. I'm a little worried too. I hear it's not that great. Our best ad sales quarter ever and doubled our commitments in the US. Oh, and they're doing live boxing matches. Remember that first live boxing match was absolutely terrible? I thought my internet was bad, and it just said, no, it was just Netflix being bad. Was that Tyson and Paul? Was that that was the battle last year where I was like, my internet sucks, and it wasn't my internet. I was getting 1 billion download speed anyhow. Finishing a great year with momentum. So, revenue, going back the last few quarters, 9.8, 10.2, 10.5, 11, 11.5, and then Q4 forecast almost $12 billion. And the stock is currently down 5.8% after hours. Year-over-year growth, you see that right there. Operating income, it's fallen from previous, but if you take, 3.248. Operating margin is what's fallen. Net income, higher. Diluted earnings per share, higher. Free cash flow. This was a company that struggled with their free cash flow for a long time. Their earnings were up here, their free cash flow is down here. We're starting to adjust that quite a bit. That's important. That's what concerned me about Netflix in the past, is looking at it going, how is free cash flow and how is net earnings so different? Let's pull it up in our software real quick to see where that's at right now. Because if you look right here, free cash flow is $8.5 billion in the last year, 10.25 for net income. Way better, because if you look right here, it was 4.23 billion versus 6.22 in the last 5-year average. That's a lot bigger difference. And it's getting tighter and tighter and tighter, which is great. Returns on capital are high and getting better. 12.7% a year for the last 5 years, 17%. Guys, if you're in our community, do me a favor. Go and vote on Netflix on what you think it's a hold, buy, sell, strong buy, whatever, and give us your intrinsic value. You can now put your intrinsic value in on the stock. Obviously, you use the stock analyzer tool to figure out your intrinsic value. But once you do, put it in there because we want people to see that value by people in the company. Growth rate's great. Margin, look at this. 5-year profit margin average was 18.5%. The last 1 year is 24.5%. Let's see what it was this last quarter. Net income was 2.5 billion on 11.5. So 2,547 divided by 11,510, 22%. That's great. So this company is getting better with this net income. That's awesome. It's way better than this 5-year profit margin number. So when you go to Stock Analyzer and you put in your profit margin, you've got to factor that in there. All right, let's see what's going on with the 8 pillars here. Okay. 5-year PE is 87. 5-year price of free cash flow is 128. It's 5-year average. This is a fast-growing company. So the 1 year is 63 on free cash flow, 53 on PE. Sounds like a lot. Is a lot. Granted, that one number itself doesn't tell you much. If the company is going to double its profit every year for the next 10 years, this is very cheap. The question is, what are they going to do? Debt levels are getting better. It's a check mark now. Not buying back a ton of shares, which is probably good to not buy a bunch of shares when your price of free cash flow is so high. Return on invested capital is getting better. Revenue's up. This is what I love. Revenue's up 19 billion in the last 5 years. Free cash flow is up 9.5 billion on that. That's half of it. 50% of it. Net income's up 7.5. So free cash flow is catching up there. That's what I love about this company. This is a great company. Absolutely great company. Analysts expect its profit to double in the next 5 years from $26 a share to $53 a share, and revenue to grow 15, 13, 11, 10, 10%. So getting better, but declining. So remember, guys, the 5th tenet of our principal dividend investing is what? It's a great story can become a bad investment if you pay the wrong price. Repeat that in your head till you're blue in the face. And while you're repeating that in your head right now, do me a favor. Subscribe to the channel. If you like earnings updates, if you like comments on the economy, if you like random videos that we're going to make, like we just came up with one the other day where we're going to pull up Twitter and Instagram and find the most ridiculous finance comments out there because there's a ton of them that just aggravate the crap out of me. Subscribe to the channel. This is a growing channel. Our main channel has 360,000 subscribers. This one's growing. And I think this one will surpass the other channel at some point here in the future because this channel is great for quick reactions. Yes, we talk about earnings not being something to dwell on, but it's still nice to see some information out there when you're looking at things. I mean, they're going to say a lot of things that are probably true and a lot of things that are probably exaggerated. Netflix share of TV time. Look at this. Netflix is in red. It was 7.5% in 2022, 8.6% now. In UK, it was 7.7. Now it's 9.4. That's incredible. Now, it's not growing as much as other streaming, but there's been a lot of other streaming options out there. But guys, that's huge. That's a huge number. That's incredible. We grow, what else is it saying? We grow engagement by expanding the variety and quality of our programming. Anybody go to Netflix and have a hard time just deciding what to watch? I love watching My Seinfeld at night. My Seinfeld at night is great. My wife and I love watching that. That's great. K-pop stuff, great. Returning seasons, Stranger Things. I never got into Stranger Things. Am I the only one? No, you too, I never got into Stranger. I don't think I was like, this thing sucks. What was that? People love it. And I'm just like, this show stinks. I never got into it. Knives Out mystery. I hear a lot of good things about that. Okay. So, they're going to start doing a lot more live game stuff. Our NFL Christmas game day doubleheader. Cowboys versus Commanders, Lions versus Vikings. It's going to be awesome. And I'm going to definitely be watching that. These are 4 great teams that I love watching. And I'm partial to the Lions and the Vikings. I like them both a lot. So we'll watch that one with bated breath, I guess you'd say. So the question becomes now, what is the right price to pay for Netflix? Guys, we got a great story. We've got numbers. We got to put them together to come up with the right price for the company. Now, I'm not telling you this price is the be-all, end-all, but put it in here first to see even if it's worth wasting your time doing any more research. I always see it the other way around. People fall in love with the company, the story, all these things. Then they force themselves to justify a higher price. No, I want you to work the other way. Go into the stock analyzer very quickly. Put your assumptions in. Is it worth your time? Let's see what I did the last time I did Netflix and what I need to modify, because I do need to modify it now. I did a 10-year analysis. I did 4, 7, and 10% revenue growth. I think I should modify that. I think I'm going to call it 6, 10, and 14%. Profit margin, definitely going to modify that. I'm going to go with 18, 22, and 26. Same with free cash flow, because over long periods of time, they're going to come together, and they're starting to come together now. Now, what's the PE? And what's the price to free cash flow I want to apply to this business 10 years from now? Well, guys, the historical average for companies is 15 or 16. I say you start there, go higher for good businesses, great businesses that have good returns on capital that are getting better, which is happening here. That means as they invest more money in the business, they're able to get better returns. If this gets even higher, it means that there's a moat status to the company. And if there's good growth potential. So I think this is a premium company. How much of a premium? I did 17, 20, and 23. I'm actually going to go a little bit better. I'm going to go 18, 22, and 26. Because guys, I believe if you ask people what's the number one streaming service, I think they'd say Netflix. It's our go-to. I think people love their Netflix. Nick, you don't agree? Okay, besides YouTube. But yeah, but YouTube doesn't make shows and stuff like that like Netflix does. Legally? Okay, good. Well, they're not making exclusive content. Well, maybe they are. I don't know. Tell you what. In the comments below, which one's better? YouTube? Nick's smiling about that one. YouTube or Netflix? I'd rather have... Listen, I think YouTube is great for making content like this, but if I want to go watch TV and like get a show and all those things and movies, I think it's Netflix for me. Oh, Nick's shaking his head. Tim's saying he agrees. What do you guys think? Okay. And then finally, guys, what's our desired return? Well, I put 12 in here, but that was before. What I want to do now is I want to figure out what's the company worth to me? What's that intrinsic value I always hear about? So I think 9 or 10%, which is the market average return, is how you get that intrinsic value. But don't buy based on that. If you're going to buy an individual company, you've got to have a margin of safety. How do you put a margin of safety in? Higher desired return. Because the more return you make, the lower the price. That's how you get margin of safety. That's how you decrease your price. Think about it this way. $1,000 phone. If I want to make 100% of my money, I got to pay $500 for it. I pay $500, I get $500 in profit. If I want to make 4x my money, I got to pay $250 for it. So the higher return, lower price. Same thing here. Then you hit the analyze button. Now, guys, again, before I show you the numbers, subscribe to the channel if you think this is wonderful and you want to watch more of this content. And make sure that when you do see our content pop up, you click on it. Our goal is to make 20 to 30 videos per month. We're going to be starting adding some other people into the videos. That way we get a variety of different ideas on this channel, but I appreciate it very much. Hit the analyze button. The stock's only down 4.5% right now, by the way. Guys, I have a low price of $370, high price of $1,300, middle price of $700. For me, I'm just waiting. I'm going to add to my watch list at $700 per share. And when it falls below then, the app and the emails will be sent to me saying, Paul, your stock has hit the price. Go take a look further. I appreciate your time, guys. Thank you for everything.